I will let you talk, Zachary, for the retail momentum screener, but just want to say a
Yes.
few words. So when we thought about Review Advanced, there was some stuff about advanced market signal, but also at that moment, I was working personally on a project of retail momentum. I wrote the story, but it started almost 3 years ago about this idea to use the fact that stock that retail love usually have a more predictable momentum and lead to run. Actually, it started with one person that I collaborated with that around the idea of we have the tech Upstart and Affirm run. If you remember, in around the end of the summer 2021, those two stock that were not super well known at the time became incredibly uh, popular and had a very strong run. So could you redetect it? And I started to work with a new data set released by NASDAQ that tracks this volume. They made it after a GME thing. So I think institutions started to want to be able to track that. So it started around that, but then all the question of, okay, yeah, if I find some run, then how do I hold that stock? How do I invest when I take my profit and all this stuff? So we built it upon that idea, and it's where we added the stock health and tune map that we'll talk after. So that is the story of, and is the reason of those three different part of that software. So retail momentum, it's mostly Zach that I've done this interface. I will let you talk about it. I will, Zach.
Yes. Let me just share my dashboard directly so that I can control it. If Vincent, you could stop sharing yours.
Yeah,
I
sure.
uh, are we seeing my Vincent? Are you seeing my
Yep.
screen?
Yep.
Okay, perfect. Uh, First, there was one last question that popped up uh, while you were talking, Vincent. So I just want to clarify this one before going forward. Uh, Betable is asking, is the current trade are just Woo trades? That's on the advanced dashboard. And yes, those trades are basically playing long on the edge signal directly. So it's not even our trade, it's the edge signal trades in context. Uh, Also, Etienne asks, how do you monetize the sector performance graphs? Would that be backward looking only? Uh, this may be more a question for Vincent, but I think it's more to look at if a sector is overly outperforming, that may be a sign of overeating that we might return back to the mean sometime soon, but sometime the market can stay irrational longer than us. So I guess that's just an indication of the current situation. And also the same, but inverse is right. Also, a sector that is really underperforming, and that through our own analysis, we might think that it might be coming up, may be a good indication that again we might reverse to the mean and come back a bit stronger in the future. But there's nothing predictive in that. Maybe Vincent, if you want to add
Yep.
something on the
No, but
sector.
yeah, I think you got it right. I mean, we express it in standard deviation for a reason that anything above three standard deviation never really lasts. It's the nature of of a statistic. So, but so maybe three standard deviation. So, for example, me personally, I wouldn't jump into ARC right now at that moment. Would probably, but it's not necessarily because it's at three standard deviation that will gonna pull back more. It's just we could see it going more in line with SPY or going more in line and cooling down. So yeah, but yeah, it all bring down, and I think it's the same thing when it's minus three standard deviation, but then it's all about catching a falling knife or jumping into an oversold, and it's all about your risk tolerance, and but yeah, uh, it's always this thing about being oversold, overbought, but the stock can remain oversold or overbought for long. So it's not that easy to yeah, the predictive value is not exactly you see it at three standard, it's a sell thing. But yeah.
Good, perfect. And final thing before going into the stock, Kevin is asking if we could create annotated chart on the advanced market chart and to help understand how to read each chart. That's actually a point I want to mention, because our next step now that our advanced offer is live is really to improve the help section of our platform. We do understand there's a lot of signal. They're all to be understood in different ways and to be used in different ways. So our next objective is, as Vincent mentioned, is to publish multiple videos explaining our tools, and also to add to our website in order to make it clearer and easier to use. So now I'll just jump right in the retail momentum screener. So first, as Vincent introduced it, the idea behind it was how could we have spotted runs such as Upstart back in the days, where, as we can see here, the first big uptrend of Upstart. I think even, the poster child of this is definitely GME, that did something just incredible a few years ago. They even made a film about it. And that's where we ended up on this data set that helps us see the retail participation in the market. So how did we package this into a tool? First, we defined our flags as a run, what we call a run. So the idea behind the run is to look at the flags not by themselves, but as a group. For example, if we look at Upstart here, we can see that there's a whole bunch of flags near the start of the run. And then we have a few ones that are near the top that would be bad or not as good trades. And if we were to count them individually, we would have like a bunch of very good trades that would increase our average gain and make it seem like the tool is better than it really is. Because it's kind of all one big trade, and each flag is increasing our confidence or showing how exhausted maybe the retail is as keeping jumping in. So that's why we package it into a single run. And what this does is, in the latest flag section that we can see up here, each line on this table is a run in itself. So a run is defined as the first flag within 100 calendar days from the previous flag, or if there was no flag, well, it's just the first flag. So if we start on the first flag here, we count 100 days calendar and look if there is another flag. So if there is another one like here, we keep going forward, and again, there is another one before 100 days up until this final one. And then we have a huge period where there is no signal. So the run is considered ended, and that's how we defined it. 100 days is not random. It's just enough to catch the next earning, because we found that there is a lot of flags that are aligned with earnings. Retail is looking at this, it seems like, to jump in or out of a stock. So having a period that was shorter than a quarter made it so that there was a lot more runs that were counted. So this one and this one would be counted as a different one, and even this one. So it led to we were more looking for mid-term trades than short-term buy and sold in a few days. Then for the table here, what we have is a few stats. First, the count is the number of flags that happened since the first one. The first one being on the start date here, and the latest one being on the latest date that is highlighted. And the table is ordered by the latest date. So you always see at the top the flag that happened the closer to today. So for example, yesterday, because we only have the data the next morning, we have seen that WBD flagged for the 7th time since May 28th. So if we look at WBD, and on this case, it's the first flag since its IPO, or since we have data. If the data set goes back up until 2016, I think. So as we may see, well, WBD flagged a whole bunch of times in a short term. Then we have the gain and the max gain. The gain is if we take yesterday's price, because the price action on those graphs is only updated at night. If we take yesterday's close and the open before the start flag. So as I said, the first flag is only known the other morning, the day after. So to compute our stat, we use the open of the next day. Even though it might not be, like in this case, it opened higher and then fell, we still use that value since it's the earliest we could take action on that signal. And then we compute the gain we would have as of the close of the last day. So as you see on the WBD would be with a slight loss. And the max gain is the gain computed from the highest closed within the run. And finally, the warning. I think there's a few questions as to what the warning means. So first, the snowflake are to highlight sectors that have shown to have less volatility. I'll call it like that. There was a clear distinction between a few buckets of sectors that had lesser, well, the wins were a bit less and the losses were also more contained, which means we saw it at the inverse at first. Like there was some sector that showcased really big returns, but also really big losses. But it was easier and I think more logical to show it as the coolest sector. And that's not to say that those sectors cannot have big runs. If we scroll down, SMR, for example, has even close to 40% run. And I have seen like IMS, yeah, that's the one I was looking at. You can have like 200% runs as a quote unquote cold sector, but on average, it is less likely to happen. Then we have the yellow triangle with an exclamation mark. W. This is to highlight a big price movement just prior to the flag. So WRD is a good bad example of it. We have seen that up to a certain threshold, if there was a too big of a move upward or downward prior to the flag, it often led to, or rather, I would say the worst runs would happen when this situation occurred. So why wouldn't we just filter those out? Well, there was also incredible runs that started like that. So when we looked at filtering them out, it actually didn't change much of the statistics because we were removing at the same time some of the best runs and some of the worst one, making the average not move a lot. And we felt like it was a better idea to simply show a warning stating that this is a high volatility flag, because we would not want to not flag one that could go on a run. But those are to be taken with a bit more caution. The counter example is LVWR. That's just one I found prior. There's plenty of examples, but as you can see, there was a big jump, even almost tripling in value within 2 days. And finally, it doubled once again after the signal. So it's just to show in 2 examples why it's not always bad to see this, but it's just riskier. And the final warning is the red circle with the exclamation mark. This one is simply to highlight smaller market caps. Those market caps, it's 100, 800 millions. Those, again, tended to either go to the moon or to the grave, but if I can say. But we again wanted to highlight those as being risky plays that could go off high, but also could go down to really big debt. Now I'll go across the statistics here. So those graphs may look confusing, but we felt it was important to have them beside the flags to always remind you of what are the statistics of each run being a success. First, the statistics are computed as the maximal gain attained by stock within the period. So that does not take into account if it dipped below before attaining that top, or if it dipped really badly after attaining the top. So playing this game would be for perfect traders, and that does not exist, but it still shows the opportunity that there is when using a flag. So for example, when reading this chart, we have here the 1 year period. What we can see is that if we go at 50%, so here it's the 30% maximum gain. So we have that 46% of all runs flagged go above 30% within 1 year. This is useful because you can have a better understanding of where your current run is compared to the average run or the median run. You can also see the buckets here under. It's the same value, but splitted as the bins of the value that stand exactly between 0 and 10. So the dots here are actually just the sum of all of those. For example, if I were to be between 0 and 10, well, all of those other buckets are also included in that value since they all went also above 0. So that's also to show where where much of the runs ended up to be, which is between 10 and 20% in that case, and it goes almost to 0 at the end. As you can see, there's a 0.34% of run that reached 200% within a year. And then we have the maximal gain reached as the average and median. The median here is really important because, as you see, there's a few outliers that go really, really high. GME, I think there's a 2,000% run. This makes the average bigger than it should be, making the value 51% for a year too big for nothing. If you were to say, oh, in average, we reach 51% gain at max, you would probably be deceived because if we look at a 50% year gain, there's only 29% of runs that reach above 50%. The average here is misleading because of those outliers. And that's why the median is an interesting value to look at. Here we have 27%-ish as the median. And the median is just the middle value. If we take all of the runs and we order them by the max gain they would reach, we just take the one right in the middle. It means that there is exactly the same amount of runs that did better than 27.35% that did worse than 27.35%. So those two, the median help put context in to the mean, to the average, and this is why we have plotted both on the same chart. And finally, I received a few questions asking how to use this retail momentum screener, and we do understand that by our decision of using warnings instead of filtering out, we created a tool that has many flags. So there's like 3 new flags on the 11th, one on the 10th and 9th, so that's not too bad. But there's some days like the 4th where there's just so many new flags, and it can be confusing to decide if I should go in, out, or whatever. And first, going in or out is always your decision on how you feel the stock can go, your analysis and your research. But we think this tool is, or at least that's how we use it. It's more like a way to draw attention to companies, to tickers that could have an interesting run. So when we see a new flag, so each morning I just go on this page, I look. So this morning I went WBD, and I went on the stock L that Vincent will present next to look at the company, and then I decide if I go for it. So it's just a way for me to maybe discover new stock and decide if I believe or not it would go on a run. I would not suggest just going on every single of those flag and trading every single of those flag. I would have to actually compute if that strategy would work, but this is not something we will be doing on our side, at least. So I guess that does the round for this product. I've not looked at the comment section, Vincent. I don't know if you've seen any questions.
Yeah, just hold on.
Okay, Betable, I see you're
Yeah,
asking to let us filter this
yeah,
table. This is a comment I've received from, maybe it was you by email or somebody else, but this is something on our list to be able to order by any of the columns. I will be looking, if it's easy, maybe it will come sooner than later. So it's on our list, and we will add this on the time coming.
yeah.
Vincent, maybe you can answer.
No, yeah, but there's one for the snowflake. Would be nice to have an explanation on site when you put the cursor next to it. Yeah, that's probably kind of stuff we could add a bit like when we go into the information things. So yeah, good suggestion.
Yes.
Yeah, so maybe I will continue. Oh, Etienne's asking to clarify the gain is measured post flag. So maybe you can
Yes.
answer.
Yes, exactly. So the gains are computed as a long position that enters on the following open from the first flag. So when there's a flag, the next day open is the entry, and then we update the gain throughout the days, and the max gain from all of those days is logged at the max gain column. And Eric asked, at a high level, what causes the signal to flag on a given stock? We're looking at the retail participation in the stock, and we're looking at outstanding participation from the retail inside this specific ticker. So when there's a big influx of retail interest in the stock, it is when it would be flagged on this table.